While the first quarter of the year proved to be a relatively buoyant period for global markets, the second quarter of 2015 has certainly been a lot more difficult. Greece continues to dominate headlines, where the possibility of an exit from the euro and a full default has really never been higher. While the extraordinary and unpredictable negotiating tactics of the Greek government continue to surprise many, really the most important question for us as investors is the impact on the rest of Europe and the financial system should Greece default. And really, I think in this respect, we're in a much better position than we were 4 years ago. Since then, most banks outside of Greece have reduced their exposure to Greek debt to minimal levels. And the systemic risks are, well, in our view, they're materially lower now. I think economically, Greece accounts for less than 2% of the EU economy. So again, there's little impact on overall growth in Europe or globally. Really, so far, the crisis has had no noticeable impact on European economic activity, which really continues to show modest improvement. And recent data confirms the trend. But of course, there are always risks that a full-scale Greek default will cause some loss of confidence across the EU, albeit only to a modest and probably short-term degree. Really, the second key development in this past quarter has been the sell-off in the Chinese stock market. And this is bound to happen sooner or later, given that in the previous 12 months, the market had risen by 150%. Taking valuations to completely unsustainable levels. Now, it's our view that the collapse in the Chinese equity market, it's mainly a domestic problem, and it's unlikely to have a significant impact to the broader Asian or global financial markets and economy. And we certainly view any sharp further falls in the Asian market as a buying opportunity on a longer-term view. Now, turning to the performance of markets, it was an unusual quarter in the sense that both UK equity and UK government bond markets retreated, both down between 3 and 3.5% over the quarter. Sterling has appreciated against most major currencies, which has added an additional headwind to the performance of foreign assets. Global equity markets are down circa 5.5% in sterling terms, while global bond markets, which encompass both government and investment-grade debt, they were down 6.8%. Against this backdrop, our diversified target return fund held up relatively well, falling just 0.25% over the 3 months. Year to date, the fund has returned 2.3%. Now, our allocation to UK equity, global developed equity markets, and emerging markets detracted from performance. However, our exposure to quality-orientated companies, which make up roughly a third of the portfolio's equity exposure, actually rose in value, so it provided a useful buffer. And again, it emphasized the real benefit of diversifying across investment styles. Our selected active global equity managers, they also performed well over the quarter, and it further dampened the negative returns from developed and emerging equity markets. Now, our fixed income allocations were generally rewarded over the period, as our exposure to Asian converts, high-yield corporates, and senior secured loans, which are all strategies with relatively low duration, were all accretive to overall performance for the quarter. At the end of April, we elected to lock in some of the strong performance generated in the first quarter by reducing our exposure to emerging equity markets by a third and selling out of our Asian convertible bond position entirely. Now, the timing of these decisions was rather fortuitous, as a correction in both developed equity and emerging equity markets followed. By the end of the quarter, with emerging markets 10% lower in sterling terms, we opted to rebuild that emerging market equity position. But we haven't as yet returned to Asian convertibles. We're going to wait for a stabilization in the Chinese stock market before reevaluating that position. Now, market volatility has increased sharply in recent weeks as the Greek crisis rumbles on and the Chinese stock market experiences a pretty sharp sell-off. Equity markets, especially in Europe and the UK, have weakened, and bond markets have seen their first sell-off ahead of the Fed's first interest rate rise. But we view these moves as a healthy correction. A supportive monetary environment will ensure continually high levels of liquidity globally. And while there are clear risks, I think none of them appear to be potentially damaging enough to result in a renewed bear market. I think this current period that we're in, this period of nervousness and consolidation, it may have further to run, but this is most likely to create an opportunity for us to add to those asset classes where valuations are becoming increasingly attractive.